Hello. Good afternoon, participants. My name is Ebelechukwu Enedah. I'm a partner in Punuka Attorneys and Solicitors, and I warmly welcome you to this webinar, very important webinar, very critical to all of us. If you're in Nigeria, it is very important to you, very, very dear to all of us. And it is about a sector of the economy we are all very conversant with and which affects all of us individually, as institutions, as individuals. And the topic for today's webinar, which is being hosted by Punuka Attorneys and Solicitors, is managing liquidity crisis in the energy sector in the COVID-19 pandemic. We shall be looking at policy trends, we shall be looking at innovation, we shall be looking at sector restructuring. And you would not regret signing up for this event because it is something that would really impact on the knowledge you have about this sector. I guess we are all keeping safe and we are all well. And we thank God that we are all able to join up for this seminar. And as we go on today, I want us to have a few introductions before we go on today, because I can see that as at our last count, we have over 400 registered for this program, and they are joining as we speak. And it's going to be a very important discourse, and your participation is what will make it very enlightening for all of us. Without your participation, we might as well be talking to ourselves, we might as well be in our bedrooms and speak to our mirror. But with your participation, we're all going to have a very wonderful discourse, and that is why I will enjoin you. You can't even afford to go away for a minute, because all the topic, all the sessions is going to impact you, and it's going to be filled with information which you need. And to take us for today, as I've said before, it is Punuka Attorneys and Solicitors that has put together this webinar. And we all welcome you, the board and management of Punuka Attorneys and Solicitors. We welcome you. Punuka Attorneys and Solicitors, we don't need to introduce Punuka. It is a well-known firm in Nigeria and also globally. It is a leading law firm in Nigeria, and we have international affiliations, and which shows even in the constitution of this panel. We didn't just bring up people from the firm or people from Nigeria, we brought people from all over because we want us to be able to have a good conversation. Punuka Attorneys and Solicitors, we have 3 offices in Nigeria, head office is in Lagos. We have another full functional office in Abuja and another full functional office in Asaba. We are well positioned to serve the geopolitical zone in Nigeria. Of course, in Punuka, we have 5 partners, and we have over 30 lawyers working to deliver solutions to clients. We don't just carry out the client's instructions, we deliver solutions. That is what we are known for. We are in over 12 sectors. So one thing you will have about Punuka is that it's a full service law firm. So when you get to Punuka, all your needs are met in Punuka. Your tax need, your commercial, even your litigation, every side, your energy needs, capital market, what it is, name it, we are all here in Punuka to serve you. And all our partners in this can attest to that. If you want more information on Punuka, you can go to our website, www.punuka.com. You can have more information on what we do. And then if you're a participant, just to ensure we have a smooth conversation, all the participants have been muted. You will not be able to speak. But indeed, you have an opportunity to ask all the questions you have. In the chat section and in the Q&A, you have all the opportunity, what you want to write, what you want to ask. We have actually enjoined all the participants and registrants to send in their questions ahead of time. But perchance we are not able to do that. You can still go ahead and send in your question, or even as the presentations are going on. And as the presentations go on, the questions will be taken at the end of the presentation, just to ensure smooth discourse. And if your questions were not taken, we would ensure that the questions are sent to the individual panelists to whom you addressed your question. And the answers are going to be published to all the participants so that we all gain from the answers given by the panelists on all the questions. And if you're asking your question, it will be important and it will be good if you can direct your question to the particular panelist you want to address your question. That will help. And you may want to include your name in the question. Also, the sessions are being recorded for privacy issues. The questions are being recorded. And as you registered and joined, you have indicated your consent to that. It is also important to note that these sessions are merely our opinions of the different panelists and the individuals that are going to be speaking to us. They are not a legal opinion. If you want a legal opinion, you can reach out to us and we would work with you to generate what you can hold us up to. Also, the presentations that will be made by the panelists will be kind enough to share it with all the participants at the end of the session. So don't be carried away with noting or trying to write or take pictures of the slides. You're going to get the presentations at the end of it. And as we go on now, just before we will come on, I'm going to be posting some poll questions. The poll questions are just to help us to panelists to gain more insight on the knowledge and the extent of the knowledge of the participants so that they will be able to direct their questions. So while we wait for other people to join up, I'm going to be posting out the poll questions, and please give us your answers. I'm going to be posting 2 poll questions and I'm taking them now. Please give us your answers. Thank you. The poll questions are already in progress. We have 12% voted. %50 voted. We're going to be closing it soon. Have 70% voted. We'll have to take it down. So we'll have to end this poll so that we can take the second poll. We have 75% that voted. We are ending it at 75%. We'll have to end it now. So the first question was, are you aware that the government subsidizes the electricity industry? 72% said yes. 28% said no. 72% said yes, and 28% said no. So we'll take the second question quickly. The second question comes now. It says, which of the following do you think is the highest contributory factor to the liquidity challenges in the energy sector? Please, let's take the poll. We have 1 minute. The highest contributory factor, we have 65%. Okay. Okay, we'll have to stop it now. If you have not voted, please, can you vote quickly? We are stopping it now. We are 75% again. Okay, I'm sharing results. 49% attributed it to poor collection and metering. 14% attributed it to non-fulfillment of commercial obligations by MBET. 1% said non-enforcement of security by MBET. And 36% said inefficiency in regulatory intervention. Thank you very much. I believe this poll has helped our panelists and will direct the conversation rightly. Thank you very much. And we're going to go quickly into what we have today. But before we go into that, let me just give you a brief into what we are here to do. There is no gainsaying that there is liquidity problems in the energy sector, which we are all familiar with. And the agenda we have for this afternoon is an agenda, like I said before, you cannot afford to miss any part of it, because all the facilitators, all the panelists, they are here, they are prepared even to tackle the different aspects of this topic that we have for today. The first topic will be the overview of the power sector in Nigeria and how the pandemic has affected us. And that will be taken by no other person than Eric Otojahi. Eric Otojahi is a senior associate in Punuka Attorneys and Solicitors and the head of the Abuja branch of the firm. He has been doing us proud in Abuja, and he's passionate about the energy sector. I believe that was what informed his going to Aberdeen to do his LLM in oil and gas industry. And to take us in the, I will leave the second. To take us in the second paper will be Chief Anthony Idigbe, and he'll be taking us on policy and liquidity issues in the power sector. Of course, when Chief Idigbe is talking, you will know from the angle where he talks. He speaks on every topic. There's no topic he doesn't speak on. In fact, yesterday I was so surprised at our office meeting that he was teaching us on food. I said, wow. So today you're going to hear him talk about something he's very passionate about, which is insolvency. And that is being mixed together with energy, another topic he's very good at. And when you talk about insolvency in Nigeria, there is no harm, and even internationally, you cannot but mention Chief Anthony Idigbe. He is passionate about it, and he is involved in developing and in the development of insolvency practice in Nigeria. He's a foremost in that regard, and I would want you to participate fully in his discourse because you will gain by being a part of it. And from there, we'll move quickly to our regulator in our midst. Of course, we cannot discuss the energy sector without having the regulator in our midst. And the regulator, representing the regulator today, will be Mr. Sharfuddeen Mahmoud, and he'll be taking us on the topic role of government and regulator in addressing the liquidity issues in the sector, policy trends, and innovation in the sector. When we meet Mr. Sharfuddeen Mahmoud, you would know that he is well versed in what he's doing. Before joining the NERC, he practiced in the financial services sector for 20 years. So when you talk about illiquidity issues or liquidity issues, he is well informed to discuss on it. Currently, he is the general manager and head, market competition and rate division in Nigerian Electricity Regulatory Commission. So he is here and he's going to be educating us on that, his topic. And then to take us in the fourth paper will be no other person than Jonathan Cohen. And his topic will be international perspective in dealing with liquidity issues in energy sector. Like I told you, Punuka, we don't just want to look at it nationally. We want to bring our international experience whenever it comes to any topic. And that is why Jonathan has come to be with us. He is the partner in charge of in charge of energy in Howard Kennedy. And he's going to not just be talking to us about the UK, where he practices, he's going to be talking about his EU approach and other transactions he has been involved in. He has handled very high profile transactions in the power sector, and that his knowledge is coming to bear in what he's going to be talking to us about today. And then of course, the final session, which you would not want to miss, is going to be a discussion between two very vast, heads in the insolvency sector. And that will be our Chief Anthony Idigbe SN and Dr. Bolanle Adebola. I have had the opportunity of seeing two of them do a teaser. And I knew that this session is something that you want to participate. It's not about two elephants fighting. We have that in our head somewhere. But when you see two elephants working at getting a solution, it works very well. And that is what I felt when I saw two of them together. So you want to be a part of that session. It's going to be a discussion between two of them as they tackle the innovative proposals for sector restructuring. You don't want to miss that because it's going to have a global perspective on what obtains in this sector. What can we do as a country? What can we do to ensure that all the knowledge in insolvency, which has been working in other places, can be brought to bear in what we have in Nigeria? You don't want to miss that session. And of course, after that session, we'll be having the question and answer. During that time, we're going to take all your questions and answer. We have lost some time already, so we want to go quickly to what we have already. And our first paper, as I've already introduced, will be taken by Eric Otojahi, the overview of the power sector in Nigeria and how the pandemic has affected that area. So Mr. Eric, please unmute yourself so that you can go on with your paper. Thank you.
Thank you, Mrs. Enedah. I welcome everyone to this webinar, and I will be talking on looking at overview of the evolution and the development of the power sector in Nigeria. And I'll be taking that from the historical perspective. Basically, my role is to consider an overview of the evolution and development of the power sector with a view to laying the basis for our discussion today on the liquidity issue, crisis, or crisis you may want to regard it, in the power sector. I will also be considering or examining the impact of COVID-19 pandemic on the liquidity crisis. It's very important to lay this background so that it gives us an understanding of how the sector has grown from where it started to where we are now, because a lot of questions will be asked as to why is the state like this? Why is this situation like this? And basically, I'll be considering, I did a two-pronged examination of the historical perspective, which I classify as the Pre-Electric Power Sector Reform Act 2005. You see that on the slide as pre-ESP, I call it EPSRA, the pre-EPSRA era. Then also I will consider the reforms introduced by the Electric Power Sector Reform Act and post-events, and how we came about the liquidity crisis that we have today. Well, I'm going to, as I said earlier, I'm also going to look at the impact of the COVID-19 pandemic on the liquidity crisis. It may interest you to know that power generation in Nigeria dates back to as far back as 1886, during the colonial era. Also, you have some private, before 51, you have some privately owned electric companies. These companies were concessioned by the then government to generate electricity for the natives, the region, native authority around that area. Some of the examples we have, NESCO, Nigerian Electricity Supply Corporation, which has concession to supply power majorly to the tin mining operations in the then Bauchi Plateau around the Jos area. You also have the African Timber and Plywood Nigerian Limited, is called HAFTA, located in Sapele, the then Midwestern region, to supply. Now, these are private entities that are given concession to generate electricity, and essentially these electricities are supplied to ECN for local distribution, as you come to see. Now, in 1951, there was a creation of ECN. Now, ECN is Electricity Corporation of Nigeria. In 1951, it was created as a government statutory corporation to take over the existing undertakings and to assume the responsibility for electricity supply throughout the country. Now, at that point, it generates and also distributes. It also buys bulk electricity from the private, the surplus generated by these private entities. Now, as time went by, in 1962, the Niger Dam Authority was created. It was created essentially to implement the Kanji project. One of the Kanji project is described as the first major project that the Nigerian government embarked on in time. And the primary purpose was to, there was an act that was promulgated which established Niger Dams Authority to carry out this construction, maintenance, and operation of Kanji Dam and other works, and essentially to generate power, amongst other things. Now, ECN, Niger Dams Authority, coming into the picture, took over, acquired several generating stations being managed and maintained by ECN. And so essentially, or principally, the Niger Dam Authority engaged in generation and transmission of electricity at that time, while the Electricity Corporation of Nigeria distributes power generated by the by NDA. In 1972, the government felt that there is need to have a single body solely responsible for generation and distribution of power in the country. And as you come to see, when Chief Anthony Idigbe, SAN, would be giving his presentation, you see that there is a policy underpinning the movement from what it used to be and to what it is today. Now, NEPA, as we all know, National Electric Power Authority, took over responsibility solely for every single aspect of the value chain in the supply of electricity, from generation, transmission to distribution. It ran to a point where there was an itch because power generation was going down and people are not feeling the impact of electricity in the country. Prior to the creation of NEPA, like I said earlier, there was the NDA that did the generation and transmission, then ECN distributes the power generated. But at this point, there was a monopoly that was created to run the power sector, essentially. Now, because of the challenge of the monopoly regime, there is a lot of issues with the system, lack of accountability, and some other things. The value is not being felt by the people. Then the government set up a committee, and that committee looked at and considered the issues around the challenges that NEPA was facing. Then eventually the result of the committee, the recommendation of the committee, that committee is the Electric Power and Implementation Committee. The recommendation, one of the major recommendations was to promote competition within the power sector, ensure good governance and financial discipline, accountability and efficient use of resources, and to create a long-lasting environment for meeting the demand of the consumers. And that committee, the result led to the enactment of the Electric Power Sector Reform Act in 2005. Now, essentially, by that enactment, introduction of competition was introduced into the market, and a single regulator was created, Nigerian Electricity Regulatory Commission, to oversee engagements, operations in the market, basically. Now, before that time, there were some independent power projects that were on ground. Then the then government, during the Obasanjo regime, created the Niger Delta Power Holding Company. Is a public funded company, which is more or less like an emergency scheme. It has a mandate to manage the national integrated power projects, which essentially involves the construction of identified critical infrastructure in the generation, transmission, and distribution of electricity. And essentially, the project that the Niger Delta Power Holding Company manages were the gas-fired plants. You see that in the country where gas were used, because initially you have generation sources like coal, you have generation sources like hydro. But at this point in time, gas becoming very important, and the need to nip at the bud the issue of the gas flaring because is very critical at this point. Now, what are the reforms introduced under the Electric Power Sector Reform Act? I've said earlier, it created a single regulator, that's NEC, the Nigerian Electricity Regulatory Commission. There was an unbundling of the entity in 2005. In view of the reform process, Power Holding, NEPA was renamed Power Holding Company of Nigeria, PLC. And in the course of the reform process, PACN was unbundled, and that led to what we have today. You have the generation companies, about 6 generation companies. You have about 11 distribution companies. Then you have the transmission company, which still remained only owned by the federal government. In 2010, still in the process of the reform and in line with the roadmap to power sector reform of 2010, the Nigerian Bulk Electricity Trading PLC, which we regard as MBET, was incorporated by the government, and it's a special purpose vehicle that was set up for carrying out under the license of NEC, bulk purchase and resale of electricity. Now, what is the value chain? What is the value chain? What is the value chain that we have today? You have gas suppliers on the one hand, and recall that I had said earlier that you have hydropower stations, you have thermal power stations also. Gas suppliers are there. They are entities and very significant in the sector that supply gas for the generation companies. Then you have the TCN that provides maintains the transition and transmission facilities. You have also the MBET, I've mentioned MBET, responsible for bulk purchase of electricity and reselling to the discos. You have the discos engaged in distribution. And at the end of the chain, you have the billable customers. Now, the revenue from the sector flows from the opposite direction. You have the billable customers making payments for electricity consumed. You have the discos collecting, making collections from the payments. Then they have an obligation to MBET, because when they buy, they have, through their vesting contracts, they purchase this power from MBET, while MBET purchase the power from the GENCOs through a power purchase agreement. And for them, it's the bulk power purchase agreement. Now, the inability of the discos to pay for electricity generated for GENCOs fully resulting to liquidity crisis. You see that the value chain, the revenue ought to flow, but because there is a break in the chain along the value chain, and essentially caused by the inability of the discos to meet their financial obligations under the vesting contract, we have what we call today the liquidity issue. Several efforts have been made by the government to address the liquidity crisis, but these efforts were not without some challenges. Mr. Sharfuddeen will be taking us on the role of the government in addressing these challenges, and you come to see the role. And if you permit me to just mention, there was a move by the government to move the market, transit the market into a contract-based market, and that met with some itch, because along the line, the discos went to court to challenge that move, and essentially to prevent prevent MBET from calling on the guarantees which they have placed with MBET, basically. We have cases that we're handling on that, and thankfully, some of the cases have been concluded and were dismissed, actually. So I think that will pave way, subject to the outcome of other litigation, will pave way for movement of the transition, basically. And also, there was the effort of the government to also open up the liquidity, to address the liquidity issue, and it's the eligible customer regime that was brought in 2017. That also met with some litigation challenges, because they also went to court, and some of the cases are still pending, some have been concluded. We hope that when these cases are up, the market will have that free space to move, basically. I'm going to consider quickly the impact of COVID-19 on the current liquidity crisis. I'll just run through so that I am a bit beyond time. One is discos. You have, for the discos, there was loss of revenue due to reduction of demand from commercial and industrial customers. The discos, the revenue flow from the discos come from the supply they make to the commercial and industrial customers. Because of the lockdown, most of these industrial entities were not operating. So we see that the revenue issue was deepened. Also, there was the postponement of the minor review of the multi-year tariff order. The multi-year tariff order is a system, a scheme of tariff where the regulator NEC would consider the tariff, because tariff issue is a regulated, a strongly regulated issue in the market. And so the MITO plays a procedure by which that there will be review. And there was an intended review, minor review, that was supposed to come in sometime in April, but because of the COVID-19, it was postponed. And the discos were not happy with the situation because of the fact that they've been clamoring for a more cost-based tariff. We have significant impact on the rollout of meters by the meter asset providers. One of the ways by which the government wanted, or is what the government is doing to ensure that there is the liquidity issue is addressed, is by creating a regime, what we call the meter asset providers regime. They are allowed to invest in provision of meters so that it will bridge that gap of metering the customers, and which in the long run will have the effect of closing that collection losses that the discos face in the value chain. You have the impact of the discos' ability to meet their payment obligation to MBT, of course, in the long run. Also, there's the impact on payment capability of electricity consumers, obstruction to ongoing power projects. But today, it's reported that the Minister of Power have actually directed that these projects should commence again. Now, the question I asked while I conclude is there a way out? Is there a way out from this situation? As other speakers give their own discussion, you come to realize and have a broader view of the challenge that we are faced in the sector. Now, I just gave two options, way out: government intervention. Government can intervene in this period by provision of some sort of palliatives. It's on record today that the discos are pushing for a CBN-funded massive rollout of meters that will expedite their efforts towards closing the gap of the metering gap that's been created. Also, the adoption of digital technology in the power sector. Technology is very important in the power sector, and it's very, very significant because even in the pandemic, you see that there was the issue of social distancing, there was the issue of how do business survive in this era. So if there is investment in this area, it will help business continuity in the power sector, and hopefully we will see the key players playing their role to resolving the issues. I think that's all. That's the general overview that I have. Thank you, and thank you very much.
Thank you so much, Eric, for starting us off with that historical perspective on the issues we have in the power sector. And that last question, is there a way out? Of course, there is a way out, which is why Punuka has put together these webinars for us to sit together and discuss and indeed find out this way out so that we can move on to that path and move to our promised land in the area of electricity supply in Nigeria. Thank you so much, Eric. We appreciate you for that. We have been receiving questions. Please, if you still have questions, please type it in the Q&A session or in the chat session. And we'll move quickly to our second paper for today. Please don't leave the dial, don't leave your desk. This is a paper you don't want to miss. Please, Chief Anthony Idigbe, SN, please.
Thank you very much, Ebele, and thank you, Eric, for that excellent presentation. Very good background and very difficult to follow. I will be talking about the policy issues and how they relate to liquidity in the power sector. Essentially, I think Eric has given us the background, for which I'm really so grateful. I would not repeat the background, so I will speak the story of the history. Can you go to the next slide, please? Essentially, just to say that, as Eric pointed out, the government policy was one of monopoly, which involved the concentration of the ECN and the NDA to create NEPA The monopoly policy was very popular for newly emerging countries in the 60s and the 70s. And the idea was that having gained independence, they didn't have the economies of scale to provide essentials for the citizens. And it was therefore the responsibility of government to play that role by creating these massive institutions that hopefully would have the economies of scale to be able to provide highly capital intensive infrastructure such as power. So that was a policy that cut across many of the developing countries at that time. But unfortunately, monopoly policy has a setback in the sense that once you have a monopoly, there is no incentive for competition, and there's no incentive for efficiency because there's no competitor, there's nobody else to provide our service. And we suffered from that, so decay arose. However, that policy issue around monopoly still remains a contentious issue under the Nigerian Constitution today. Because if you look at section 16, subsection 1 of the Constitution, under chapter 2 of the Constitution, the fundamental objectives, directive principles and objectives of the state, it says that the government shall continue to control the commanding heights of the economy. And that has been interpreted to mean that the government should maintain a monopoly. Indeed, when the reform process started at the implementation stage of the Electric Power Sector Reform Act, the National Association of Electric Workers did go to court contending that the privatization process was unconstitutional, relying on section 16, subsection 1B. And we had the privilege of being involved in that case. Well, the case was eventually settled, but the issue was there. However, if you looked at section 16, subsection 2B of the same constitution, it says that the government shall ensure that there is no concentration of wealth or concentration of a means of production or exchange in Nigeria. So the same section that says that the government shall have commanding heights of the economy stipulates that nobody, which of course includes the government, should have a monopoly of production. So it's clear that looking at trying to reconcile the apparent conflict or perceived conflict between section 16, subsection 1 of the Constitution and section 16, subsection 2B of the Constitution, my preferred interpretation would be that the commanding height of the economy referred to in section 16, subsection 1 is the regulation of the economy and not the appropriation of the means of production, which would be unconstitutional by virtue of section 16, subsection 2 of the Constitution. In any event, the entire section 16 being situate under chapter 2 of the Constitution is not justiciable. It's just an aspiration set for the state. And as decided in another case, I wasn't involved in this other case, the case of Attorney General of Ondo State against the Attorney General of the Federal Attorney General. It was held that although the provisions of Chapter 2 are not justiciable, the National Assembly could, by legislation, give them flesh. And they used that to justify the enactment of the ICPC Act for elimination of corruption under Chapter 2 of the Constitution. In the same vein, the Electric Power Sector Reform Act gave life to the provisions of sections 16 subsection 1 and section 16 subsection 2 by creating a new policy, a new regime that moved the country from monopoly towards competition policy. By creating the institutions that Eric has mentioned, an independent regulator, breaking the monopoly of NEPA, unbundling it as he has spoken, and maybe Jonathan will say more about it, and then trying to create competition between the discos, and then the having a transmission company to transmit, and then create competition between the GENCOs. So the intention of the reform is to lead us to a competition policy. The idea is that competition would bring down the cost for the consumers, because as people compete, the consumer triumphs, prices come down. And we saw that happen successfully in telecommunication industry when the NITEL was broken, and then the new licensing regime was facilitated by a new regulator, independent regulator, NCC, and successfully, prices were high initially, but as the competition went on, the prices crashed, and now we can do this webinar for a little or no cost. Now, that was also the vision for the power sector. But where are we? In that vision, there was supposed to be 3 stages of transformation from monopoly to free competition. Unfortunately, if you did the analysis today, we are not in monopoly per se, but partly still in monopoly, as I will show, and we are very far from free competition. So we are in what I term stranded policy. Our policy today is stranded, and there are certain indices that tells us why. So if we agree that the intention of the law was a policy change to move from monopoly to competition, then I ask certain questions, certain critical questions. Okay, monopoly meant that somebody has exclusive power to supply you power, right? And you have no choice, but you must use them. So I then ask the question, if you then say you are trying to move to competition and you have broken down the monopoly, how come if I am within a particular area, I can only use one particular distributor? Which means that the distribution companies still have monopoly. It's just they have a smaller monopoly over a small area. Why can't I decide, if I'm in Lagos, that I want Kaduna Distribution Company to supply me electricity in Lagos? Why must I be stuck with a monopoly, a smaller monopoly in Lagos? So we have to sort of like interrogate the policy and say, what was the intention when the law was made? Where are we supposed to go to? And then you have this complex structure that has been mentioned with MBET in the middle, trying to guarantee that the GENCOs will receive their money from the DISCOs. And then he says that, well, the DISCOs can't pay. And then what happens? The GENCO produces electricity, and nobody is going to pay for that electricity. It will waste. We call it the stranded electricity, stranded power. So what happens to the stranded power? We are producing enough electricity, but nobody is buying it, and there's no secondary market where it can be sold, like a spot market. Yeah, if you produce power, if you produce crude oil, for instance, and nobody can buy it, you put it in the ship and then it will be floating all over the place. Eventually somebody will buy it, in the spot market. So how come we don't have that system to deal with the stranded electricity? We had the privilege of advising on that. Eventually came with the eligible customer regime, and then litigation started. This goes going to court, trying to prevent the litigation, the eligible customer regime, to achieve the use of the stranded electricity. So you see again the policy confusion going on in terms of all the players not either understanding the policy or preferring not to enforce it. And the government is stuck in between. And the government continues to give subsidy to manage the gap between the distributor and the generators. That subsidy automatically means that we haven't moved an inch or much inches from where we were with NEPA, because the government is still putting its money. The idea of free competition is that there'll be no need for the government to put its money. The system will just function based on market demand and the supply principles. So we need to, the policy is still stranded at some point, and we still need to think about how we can move it forward. So have we looked at the current position, the challenges? We are not in free competition, neither are we in monopoly. Clearly, we need to find and do some sort of review. And now, when I talk about review, I make it clear that my position is that there's no need, the policy is okay. The policy of moving towards competition is okay. There's no need to change that. It's a good policy. Eventually, it will lead to fall in prices, and then it will lead to better quality services. But we need to pursue it more vigorously, let me put it that way. And I will not go into the statistics because there are those who will talk about it. All I can say is that we now have so many monopolies. Apart from the discos being what you call mini monopolists, now MBET is acting like a monopolist. Because you are stuck with these contracts. Let's say you have a purchase contract with them. They don't want you to go outside the purchase contract. You must sell to them, even if you have opportunity to sell outside. Meanwhile, they don't have the capacity to take what you are producing, but you must sell to them. And so everybody's a monopolist in the system. And we need to deal with those issues. So I think in terms of the policy, we need to accelerate the transition towards competitive markets. We need to accelerate it. Make bilateral contracts more accessible. I know that Jonathan has a different view about the level of involvement. Now that there's a challenge with funding embed subsidy, I think we should be more innovative and look at maybe the idea of a sovereign note, a sovereign debt note, which would be postponed for say 3 years or 4 years. That will help us in this pandemic. So instead of paying directly to the Gencos, they can give them these notes redeemable in 3 years or 4 years. And then that will ease the pressure on the government, given the pandemic that has reduced income. That's one way to manage it. The second one I've mentioned is to consider the idea of creating a secondary spot market, where no questions are asked. If you have stranded power, put it in that market and then let it be sold. Anybody buys it, and then, and then we begin to think, I think we should begin to think about our country in a different manner. We have the opportunity of dominating the economy within the West African area. So even looking at the Nigerian market, we shouldn't be looking at our power sector from Nigerian market anymore. We should be having a regional policy. I'm talking about, you know, dominating supply and distribution within the West African corridor. So there are so many things that we can look at in terms of policy reform, and we should look at the idea of breaking the monopoly of the discos and making them to, you know, they shouldn't have this territorial exclusivity. Let's go back to achieve the original objective of competition policy. And it's, after all, what is disco? A disco is just a customer service, nothing more. Ability to send a bill out and to give you a meter, that's all. The rest of the chain, once you produce the power and put it in this system, it flows like water and it comes out anywhere. You just measure it by the metering and then the service that you give. So it's just a customer service, and anybody can give it anywhere. And they need to be better recapitalized. You know, in the banking industry, when they wanted consolidation. So you talk about a meter problem. When we looked at the survey, for the majority of people spoke about metering problems and the rest. Now, lack of capacity is what is leading to lack of capacity to finance the whole metering system is the issue. So improve capacity in the banking industry. When they felt the banking industry was too small, they used regulation to force them to increase capacity through recapitalization, and they grew. They had to merge and things like that. I think we need to, there's so much we can borrow from other sectors in the economy to address our power sector policy issues. I can go on and on, but I would like to yield at this stage because we still have opportunity for opportunity for dialogue on the insolvency side, because again, on the insolvency side, there are lots of opportunities for what we can do. Thank you.
Thank you so much. I can hear the applause already. I can feel it already. Thank you so much, Idigbe, for that. We are not disappointed. You know, you have raised very solid points in your presentation, and thank you very much for that. Because really the questions have kept on flying in while you were making your presentation. When we have all this leave to borrow from other sectors, why has this not worked for the energy sector? Why has this remained a problem? When we have the banking sector reform, when we have the reform in the telecommunication session, you know, thank you so much for bringing out these issues, and the questions are there. And, you know, I'm just getting excited already at the discourse we are going to have at the end of today's session. But we're going to move quickly to our next presentation. And before we do that, we want to take another poll quickly. Another poll is going to be posted now. There is another poll we want to take. These polls are to help us to manage and the facilitators to know exactly what to talk about. So the third question we have now is, I'll stop the poll now. Once we get to 50%, I will stop the poll because we need to move. I've stopped the poll. I'm sharing the results. Do you think the ongoing pandemic has worsened the liquidity challenges in the energy sector? 66% said yes, 13% said no, and 21% said not really. We are still where we are. So thank you so much for participating in that poll. Thank you so much. So we're going to move quickly to our next presentation, which will be taken by Mr. Sharfuddeen Mahmoud, who is the General Manager and Head, Market Competition and Rates, Nigerian Electricity Regulatory Commission. It's important to listen to this presentation because really the regulator is here and is going to be speaking on what the government is doing. And I know most of us will have questions, so it's important to pay very keen attention to know what has been done and what is ongoing already, so that you will know where we are going to all have to put our hands to ensure that this ship is taken safely to berth. Thank you very much. Mr. Mahmoud, the floor is yours.
Thank you so much. Thank you so much, Ebele, and a very good evening to all our participants. I want to start first by probably providing some additional insights, despite the fact that both Chief Idigbe and of course Eric have done a very good job in providing a background for me. But I believe it is also important for the sake of our participants that I made some additional clarifications. Currently, because Eric did mention the fact that at the time of unbundling, PSCN was unbundled into 6 generation companies, 11 distribution companies, and of course, 1 transmission company. So a number of people I know may ask, do we only have 6 generation companies operating in the grid? The answer is no. We have currently 28 generation companies registered on the grid. 28 generation companies registered on the grid, and currently 24 of them are operating and supplying to the national grid. We also have a number of independent power producers that have been registered by the Commission. Of course, a number of them are still yet to commence commercial production. But overall, currently, we are generating, or we have an installed generation capacity of 11,000 megawatts, 13,000 megawatts. That's the installed generation capacity of the country. And on average, the available generation is only about 4,000, 5,000. So it is important, I think, for this clarification. Also, Chief Idigbe mentioned the fact that we need to move towards competition. The eligible customer regulation is the beginning of additional opening of the market towards full competition. This is the beginning. And of course, eventually, the intention is that every other customer will be eligible for competition. That means aside those major customers or major consumers that currently take at least 2 megawatts and above, every other customer of electricity will be allowed to have a choice. But this is something that can be done gradually. So back to my paper. We have an outline. If we can go back to the outline, that's before this. Okay. I will start first by defining or explaining the regulator and what his role is, how we determine tariff, the concept of revenue requirement and tariff setting, what is cost-reflective tariff, the cost-reflective tariffs, the allowed tariffs, and of course, the current tariff shortfall that we are having, which are some of the causes of the liquidity issue we are talking about. Then I will give a breakdown of the discourse tariff shortfall between 2015 and 2019. I will also provide the average end user tariffs and the tariff shortfall. Then the projected 2020 revenue requirement, breakdown of 2020 tariff, the minimum remittance requirement, and of course, the effect of under pricing or the low tariff we are currently charging. Then the various federal government interventions so far to ease liquidity. Subsequently, we look into the COVID period. What has NAC done and what is the government doing? So the regulator, we all know who the regulator is in the electricity sector in Nigeria. It is the Nigerian Electricity Regulatory Commission. The commission is established by an act of parliament. That's the Electric Power Sector Reform Act. Already Eric has said so much about this, and Chief has also mentioned so much. But our role is clearly defined and well set out in the Act. It says clearly what our role should be. Some of the objectives of setting us up include to create, promote, and preserve efficient industry and market structures, and ensure optimal utilization of resources for the provision of electricity services. Another objective is to ensure that prices charged by licensees, that the tariff, are fair to consumers and are also sufficient to allow the licensees to finance their activities and to allow for reasonable earnings for efficient operations. I highlighted this in red because of their importance. Every business or businesses can only survive if they can be able to recover their cost. The only incentive to be in business is to recover costs and also be able to even earn an additional income or make a profit, which should be the incentive to continue to be in business. But these prices must be fair. That is why you have a regulator. And fairness on the side of the investor is for him to recover his cost and have an incentive to even do more. We're also charged with the responsibility of ensuring that there is adequate supply of electricity to all consumers. And in doing so, we need to ensure that all our regulations are fair and balanced. We are supposed to be unfair. So it is a very difficult task of balancing the interest of two parties, the consumer on the one hand, and of course, the investor or the utility on the other. So the next slide. How do we do this? This is the tariff determination process. The law also provides guidance for this. It is not that it is not left for the Commission to on its own make a decision. The Electric Power Sector Reform Act provides guidelines. The Act says we should adopt one or two methodologies for tariff determination. That's how we came about with the multi-year tariff order. And the essence of this tariff determination process is to ensure that all these licensees, all the utilities that operate efficiently are able to recover their costs and also earn reasonable return on their investment. The tariff should also serve as an incentive for continued improvement of technical and economic efficiency with which the services are provided. If the tariffs are low, the utility may not be able to have enough financing to undertake maintenance of its equipment, nor will it be able to even pay salaries of staff that are responsible for undertaking the job. Through the tariff also, we are supposed to ensure that we do not encourage, or it does not encourage, undue discrimination between consumer groups, which unfortunately to a large extent, up to now, that is what succeeds. Because a number of customers currently are subsidizing others. Mainly the industrial class are the one subsidizing the residential customers, even though it is more costly or more expensive to serve the residential class. So part of our responsibility is to ensure that we gradually phase out this cross subsidy. So the tariff determination process. From all indication so far, we all know that the biggest problem or the biggest issue currently in the Nigerian electricity supply industry is that of tariff. That is what I call the elephant in the room. Tariff is the elephant of the room. We wouldn't be talking about liquidity if there is no tariff. Assuming electricity is free and someone is just taking it without paying a kobo. So tariff is the biggest elephant in the room. So how do we determine tariff? What is tariff? The tariff essentially is the revenue requirement. That is the total amount of funds or money required to provide service. We can be, let's take it very simple. Assuming you are selling meat in the market. You are a butcher selling meat in the market. And you have a tariff, of course, or a price per kilogram of what you sell. How do you determine this tariff? This tariff is essentially the total amount of money you require to buy the live animal that you slaughter, you skin, all the costs involved, including your transportation cost, including the people that help you or that you employ in providing these services. So that is your revenue requirement. The total amount of money you require to ensure that you put that meat on the table and you sell to the people. This is a simple example. And of course, if what you charge at the end of the day isn't enough to cover all your expenses, it means you will be operating at a loss and you won't have any incentive to continue to be in business. So it is on the basis of that total cost that you assign to whatever volume or whatever weight of meat you have. You share it, you share the cost based on that, and you get your tariff. So it's almost the same thing with electricity. Over the years, the government has not allowed the industry as a policy to charge the full cost reflective tariff. That is, the government has been putting a cap. The regulator computes the tariff. But then the government puts a cap as to what should be charged by the various distribution companies. We shall understand that this tariff belongs to the whole chain in the industry. The generators, the transmission company, and of course, the distributors. Generation company generate electricity and they sell it to the Nigerian bulk electricity trading company, who through a business contract sell the same electricity or power to the discos. The process of transmitting what is generated by the GENCO to the disco goes through a transmission company, that's the transmission company of Nigeria. And just like Eric mentioned, it is only the distribution company in the whole of this chain that has the responsibility of collecting money meant for the whole of the industry. So if a cap has been put on what the distribution company can collect, it means at the end of the day, it can only collect a portion of what is due. So through this process, in 2015, the cost reflective tariff was 33 naira 72 kobo. But the distribution companies are only allowed to collect 24 naira on average. In 2016, it was 45 naira, and the allowed tariff was only about 30 naira. That means we had a shortfall of 16 naira. In 2017, the tariff was supposed to be 47, but the allowed tariff was 31 on average. In 2018, it was 50, and the allowed tariff was 31 still. 2019, it was about 60 naira, and the allowed tariff was 31. Currently, we are talking of 54 naira, and the allowed tariff was still 31. That means since 2017, in spite of the inflation, the depreciation in the value of the naira, and the increase in the price of so many things, electricity pricing or electricity tariff has remained fixed. So overall, between 2015 to 2016, the discourse were virtually collecting or allowed to collect less than what is due. And the government during this period has been providing the difference to a large extent, even though this government intervention or the government funding has been to a large extent haphazard. And the biggest losers in this, of course, are the GenCos, because they are the one at the downstream. So if a disco collects money and receives an invoice from the market operator for settlement of transmission companies' obligations, and that of NBET for the GenCos, it is only able to settle a portion of that. The next slide, I think we don't need to go through these shortfalls and the breakdown, but maybe we'll go to the minimum remittance before this. Minimum remittance 2020, yes. Arising from the challenges the industry was having, and based on the fact that the discourse rejected the efforts of the regulator and even took the regulator to court when we decided to have an escrow account that we thought will have provided a fairer way of sharing whatever is collected. The Commission came out with a minimum remittance requirement in the industry. This minimum remittance order prescribed a minimum percentage of invoice that must be settled by DISCO. Thus, NBET's invoice for generation, and of course, the market operator's invoice for transmission. The minimum remittance for 2020 is as per the table here on the screen. Abuja DISCO is expected to remit 42% of its generation invoice, Benin 35.7%, Eco 43%, Enugu 50%, Ibadan 28%, Ikeja 49%, Jos 8.5%, Kaduna 29%, Kano 38%, Port Harcourt 28%, Yola 12%, and the overall average was 36.4%. Thus, based on an exchange rate of 306 naira to the dollar for the period January to February. That has been fully captured in the Commission order issued in December 2019. But of course, with the official depreciation of the Naira to 360, that too has changed. So what are the impacts? Or what the impact of this tariff shortfall? What is its impact on both the GenCos, the TCN, and the distribution companies? For the discourse is common knowledge to all of us that arising from their inability to have their full revenue requirements, they have been unable to meet our customers. They have been unable to do a number of things required for efficient delivery of their services. Nothing can be done without adequate financing. So that has been a challenge. And it is a very vicious cycle because it affects all members of the power supply chain. For the transmission company, the fact that they are unable to get their full revenue requirement, which by our minimum remittance order is kept at about 50%, they too are facing serious challenges, and these challenges impact on the overall efficiency of the industry, because TCN is unable to undertake the required investments in upgrading its network, in expanding the network, and that has gone a long way in constraining its capacity through available generation. As I said, we have an installed generation of 13,000 megawatts, but the available generation is only about 5,000. So even that 5,000 is hardly effectively willed at any given time due to transmission constraints from the TCN side. And for the discourse, too, they have so much constraints within their distribution network. And these are all things that can easily be fixed if the money is available. And overall for TCN also, arising from its inability to fully recover its cost, you find that a number of projects it is undertaken end up to be extended. So it takes longer for TCN to finish its projects. And of course, that means additional cost. And this cost end up becoming part of the tariff. So for GenCos, also, this probably has the greatest impact on them because they are at the receiving end. If they are unable to receive their full revenue requirement, it means they won't be able to pay money or to pay for their gas supplies. A number of discos now only receive gas on best endeavor basis. That means they cannot be able to fully produce to their platinum capacity. So these are some of the issues caused by the resulting tariff shortfall. And of course, these are major challenges that can best be resolved if this industry or if this sector can be able to fully recover its cost. But what has the government been doing on this? Between 2014 and 2015, the Central Bank of Nigeria disbursed 200 and, in 2014, the Central Bank approved, 2015, the Central Bank approved 213 billion intervention facility. That's the Nigerian Electricity Management Service fund, the NEMS fund, which was used to pay the tariff shortfall for all market participants and outstanding debt.
Hello, Mr. Mahmoud. Hello,
Yes.
Mr. Mahmoud. Please, you may need to round off quickly so that we can be able to take the other presentation.
Okay. Thank you. Okay.
2 minutes. Thank you.
So the government put in 213 billion in 2014 and 2015. Between 2017 and 2018, there was 701 billion. And of course, there was 600 billion currently. The next slide. So, COVID. Now, what have we been doing? That's the next slide. Okay. We are supposed to have an extraordinary tariff review, which will have brought in a new tariff by April 2020. But arising from the response of consumers during the widely held consultation we had, and of course the impact of COVID that had to be deferred. And of course, since then, we have been engaged in a number of consultations with stakeholders, and we have done quite a number of things. One of them was refueling the order on estimated billing and issuance of a new order on capping of estimated billing. The Commission also directed the TCN to align and prioritize its investments so that they can be able to resolve the interface challenges they're having with Discourse. This is with a view of ensuring firm improvement in supply by Discourse to their retail customers. We also directed that they should sign a service level agreement with the Discourse so that each one can be held accountable for failure to perform. We are also in the process of introducing a new or approving a new tariff design that is based on service levels. It won't be the normal thing. We all know there are places or customers that currently enjoy almost 24 hours of supply. So the thinking now is that all those enjoying higher level of supply, more efficient supply, should be able to pay full cost for the services that is being provided. We have also created opportunities for the Discourse to sub-franchise. So the FGN federal government intervention, the federal government is also committed now to funding tariff shortfall up to June 2021, that is up to next year, to also make the Discourse balance sheets more attractive to attract financing. The federal government is taking over all the outstanding tariff shortfall outstanding in the Discourse balance sheets. This is expected to be done hopefully within this month. And of course, we all know about the Siemens project. And recently, the World Bank approved 750 million support. But this is subject to a tariff review. And there is a window for another 1 billion from the World Bank. And the federal government has also set up a committee. The Honorable Minister of Petroleum Resources has set up a committee to review gas pricing. The expectation is that hopefully with a review, a downward review of gas pricing, which we are hoping and which we are proposing and hoping, the overall price of electricity will also drop. And the government is putting in place a new mechanism in ensuring that all ministries, departments, and agencies settled their bill. Thank you.
Thank you. Thank you so much, Mr. Mahmoud, for that very a well thought out paper. And I can tell you that it is heartwarming to receive the information on what the government is doing, because of course, when the regulator begins to act like the regulator, there is hope for the populace. Thank you so much. We have seen what the government is doing, and this is a very good time for us to be having this this very webinar, because we know that at the point of implementation and when the foundation is still being done, that effective work can be done. That is why Punuka attorneys and solicitors was very forthright in taking up this webinar at this time, so that we can all be carried along in what the government is doing. Thank you so much again for that paper. And for us to go quickly to our fourth presentation for today, I'll be calling on Mr. Jonathan Cohen of Howard Kennedy to take his paper. Hello.
Hi there. Thank you, Ebele, and I'm delighted to join you in this excellent webinar, and thank you for the previous presentations, which have been very informative. I'm going to give a quick overview of some of the international liquidity issues and offer some suggestions of possible solutions or ways to improve some of the challenges in the Nigerian electricity market. If you could go to the next slide. So just some of the things I'll be talking about in the agenda: the impacts of COVID, what a liberalised energy market looks like in Europe, and then looking at some of this and offering something. Next slide, please. Just very quickly, Howard Kennedy. So we are a law firm in the UK based in London. We have over 150 lawyers and about 55 partners now. And one of the key sectors that we work in is in energy. And really, we advise clients internationally on what is bankable, what is investable from a project development and also corporate M&A national perspective. Just very quickly, just to give a bit of background to where we are up to at the moment in terms of impacts of COVID on the global energy sector. I think it's plain that there has been a detrimental impact generally. And I think there's a drop in oil and gas prices. Demand of electricity has been depressed by about 20% or more during lockdown. But actually, on a positive, there's an increase in renewables with their low operating costs and their preferential access in many power systems. And actually, we'll see more renewables on the system, including it's going to rise by nearly 5% in 2020. I think also some of the impacts we've seen are impacts on construction, so construction delays, down of inventories, pressure on supply chains, and fluctuation of power prices. And so against that backdrop, it's been quite a challenging few months for projects. Next slide, please. But I think, as I said, there is a positive about all of this in that we're seeing lots more technologies coming online. A drop in energy demand means that a drop or a reduction in local air pollution, especially in cities, and so a global CO2 reduction, which I think you'd probably all agree it can only be a positive. From a legal perspective, what we've seen in the last few months is really a contract stocktake of what the project agreements look like. And by I mean that lots of market participants are looking to either get out of their agreements or looking at ways that major provisions may kick in. And by that I mean looking at ways in which what's excusable event for a contract and whether the terms of the contract, which were economic at one point, are now not, including supply chain issues and whether parties or entities can actually excuse from some of those obligations. So quite an interesting time from a legal perspective as well. And looking at sort of payment obligations within contracts from counterparties to see if actually, again, force majeure can excuse some of those terms, which are looking very different now, or we're looking at them in a less favourable light because of the impacts of COVID. Next slide, please. I just thought it'd be useful to give a quick overview of what I think a liberalised energy market would look like. And really the point of this is that a liberalised energy market can actually really boost or incentivise the economic development of a country and really drive growth and I guess wealth for a country. And so I've just put on this slide a few bullets of what a regulated or liberalised energy market might look like. So creation of a competitive market for electricity, the breakup of monopolised supply. Previous speakers have spoken about that, the sort of how we can improve a monopolistic position. Separation of network maintenance from generation, separation of direct supply from generation again, and creation of incentive structure. I think one point to note is that in the UK, EU and elsewhere in the world, there are monopolistic provisions. So for example, in the UK, we have a monopolistic distribution system. And I think the word monopoly, a lot of people think, well, actually that's open to abuse because there's only one provider. But actually, I think the point to make here is that monopoly doesn't always mean a bad thing, as long as the regulation, if you like, regulating the behaviour of those monopolies is adequate, and we can come on to what that might look like. So I've pointed out here the creation of incentive structure to set market prices in monopolistic competitions. privatization of formerly state-owned assets. I think there's lots of countries around the world. UK, Nigeria has also gone through privatization. Actually, that again points towards a liberalized energy market. And again, obviously, market governed by a robust regulatory framework. I think that is absolutely key in order to grow the market. So just very quickly on the UK model, I'll go through these slides quite quickly so we've got enough time for questions at the end. The UK model is a privatised market. There's no state control or ownership of any of the entities. There is a government department that, if you like, provides policy, and a regulator called Ofgem that is responsible for granting licenses to the different market participants. In the UK, I think slightly different to Nigeria, we have broken up the market participants into generation, distribution, transmission. And in Nigeria, you have the discos that do the distribution. Again, this slide is just showing it pictorially what happens. We are in a quite an interesting time in the UK in terms of the energy transition. Is what it's being termed as. We used to have a lot of large-scale coal-fired power stations that per country. Now what we're seeing is lots of more nimble, what we call distributed generation assets and renewable assets. That prevents different challenges for the system in terms of things like inertia and intermittency. And so we're grappling with some of those issues as well, and actually how you go about charging the system. The transmission network, as I say, this is typically over 132 kilovolts in the UK. That one transmission operator, and again, is put here. They have a based framework. Revenue, which equals the incentives plus innovation plus output. So again, this is the regulator is clearly regulating what this monopoly can do. Next slide, please. Distribution networks, again, similarly, each area has a distribution network operator. They have strict price controls, which are set for 8-year periods. They have what's called due offers. The suppliers pay that to, if you like, carry the power over the distribution network operator's area. Next slide, please. Freedom in electricity supply. So these suppliers, they supply power from the network to the customers being domestic customers or commercial, industrial and commercial customers. There's a whole electricity market where suppliers buy electricity in bulk from competing electricity generators and other suppliers. So it's a very liquid market where suppliers can go into the market and buy their powers directly from the generators, or they can do it over the market indices, spot market, etc. In terms of the retail market, this is very competitive, so it enables customers to contract with any one of a number of competing electricity suppliers. The market is dominated by the big 6 suppliers, but there are smaller players and niche suppliers who meet specific needs in the market. So I think just a takeaway from that is, that there is complete control over who you can choose as your supplier, and it's quite transparent in that sense. Just moving on to the Nigerian market, I think I've set out in the following slides a few of what I think of the probably the market challenges and offering some solutions. There may be an element of crossover with our previous speakers, but I just offer some analysis and potential solutions. So I think from my perspective, looking at the market from outside, there's been tremendous progress in the last probably decade. But from hearing our previous speakers, there's probably quite a bit of work still to do. And I think one of the key things that having Nigeria gone through a series of privatizations, it only works if the market signals are robust enough to attract the investments, the expertise of new sector entrants. And I think probably a question mark is whether, as currently governed, whether the Nigerian market can attract external investment. And I think when you get to a position where external investors from outside of the country are looking to invest in the market, I think that's probably a place that is quite attractive. So just going back one slide again, if you can. If you can just go to the previous slide. I think the the privatisation of the Gencos and the Discos were largely financed with debt from the Nigerian banks, with some equity from Nigerian sponsors, and really the key issues, as I see it, are the cash shortfalls in the sector, the low Disco payments, insufficient gas supply to power the existing and expected generation fleet, and probably an electricity transmission grid that may need to be upgraded or is maybe insufficient for potential growth going forwards. And again, as I mentioned, all of these issues, will foreign investors perceive the ratio of risks to rewards too high to justify investment at the moment? A question, perhaps for the audience. So I've set out in the next slide the privatisation. I won't go over this because our previous speakers have so eloquently talked about this. But if you can move on, so that's the privatisation. We all know, what that was about and what happened, which has been a positive. If you can go to the next slide. So again, this is just pictorially what has been described, but I think it's quite interesting here, just to note that the way the market is structured, and having the power purchase agreements from the Gencos to MBET, and likewise having the sale of that power to the Discos by way of the vesting contracts. And I'll talk a bit about whether that structure has its limitations or if there's any way to improve that. A bit of a busy slide, apologies for that, but I thought it was just interesting just to pictorially point where the distant past and the future. And I think Eric and the other speakers have really done a great job of talked about where the market was and where it's going to. But as I say, I think on the right hand side, how do we get to the future, which is privately owned Gencos, bilateral contract with the Discos, and I'll talk a bit about some of the possible solutions or how we can get to that place over the next couple of slides. So I think, as I see it, the first challenge is the liquidity, and we've talked a lot about that today, and the financial constraints of the Gencos as a result of poor remittance from the Discos. I've put some probably a bit historic now, some of the statistics there in terms of the Discos indebtedness to MBET for the tune of about 79 billion euros, and actually the performance in terms of invoice payments of some of the Discos. As I see it, looking in, and the audience and some of the speakers may have a view, in terms of solutions. How do we improve this? Could the FGN negotiate the transfer of certain Discos into public ownership? Now that may be a controversial statement given that the privatisation has happened. Question for the audience. Discos remain privately owned, but just go back. Discos remain privately owned but supported by FGN and seeking some sort of development to finance backed programme investments. And of course, as the previous speaker Sharfuddeen put it, the Discos will struggle to raise additional capital whilst their businesses are in effect loss making without the intervention of the public sector. So how can we improve that position? And I guess probably in terms of efficiencies, could the Discos minimise or better manage their costs, increase transparency of the process? And a question here is that I saw in the UK and other Western countries, we have the distribution and supply are two separate activities. I know that Discos do both, so they distribute and they supply. Question mark, could we separate that out in Nigeria in the sector? So actually you have two different activities, which may actually improve some of the liquidity issues. Poor infrastructure. So, I mentioned this earlier, that there's a lot of investment is seen to be required to the transmission infrastructure to make it fit for purpose. Some potential solutions: could the private sector participate in the transmission sector in order to do that? Distributed generation options, so smaller, more nimble power stations that are connected to the distribution system could reduce the need for the overall transmission network upgrades and alleviate some of these capacity constraints. So off-grid utility scale or solar PV plants, that sort of thing. Is there the desire to introduce a sort of public-private partnership program for the transmission sector? And FGN could oversee the procure and pay for investments in the transmission gas supply and network infrastructure. And as we've already mentioned, gas supply will also need to be improved, and the cost of gas to escalate towards a cost-reflected price, as has already been mentioned. But given that MBET are so key in the overall market in Nigeria, I thought it's worth just pointing out some of the possible challenges and solutions here. So I guess MBET, albeit is 100% owned by government, I think has probably a limited balance sheet itself, and therefore concerns about creditworthiness and its ability to offtake and pay for power. And I guess that's from a perspective, because it's so key, it's in the middle of the buying and selling of the power. Could it be properly capitalised and supported financially by, for example, FGN, in ensuring payments are made to the GenCos on time and in full? And again, liquidity and credit support should be provided for the benefits of the GenCos. So credibility of offtake and lowering payment risk are key to ultimately reducing the price of power. And the final 2 points, FGN and NARC maybe abandon the rush to introduce a bilateral market potentially. But the MBET model should be retained until DISCOs are profitable and represent an acceptable credit risk for the GenCo. And then finally, just as I see it, the tariff structure, and I know that the previous speaker spoke about tariff structure, but I guess that, the issue here is that the tariff structure should support sector liquidity. And so again, potential solutions here. The PPAs provided by MBET could reflect a cost plus model, but should this be on an individualized basis to reflect differing GenCo costs? So each GenCo has an individual power tariff, for example. Inclusion of cost reflective tariffs, as I mentioned. And could FGN clarify and agree with the GenCos the basis on which it procure power from them, whether it cost plus or a flat tariff? And then we have sort of foreign exchange risks, which may lie with the public sector to attract foreign investments. In case there's the US dollar naira market is not liquid at a particular time. So really, the final slide in terms of conclusions, it was really just to give you a very brief overview of sort of the UK and EU markets, and then offering some possible insight into the Nigerian markets. And I think probably for me, it shows that the market has made some excellent progress to date, but as our previous speakers have said, there's probably a bit more to do. But I think, on a final note, I think having looked at various electricity systems around the world, one thing is quite clear: to have a competitive, liberalised, regulated energy or power system really does grow the economy. And I think, just to echo the previous speaker, actually it could really grow the Nigerian economy to the extent it hasn't done so far. So I think this particular session is very timely, but also absolutely valuable for the growth of the economy in Nigeria. So that's all I want to say, but thank you very much for inviting me to speak.
Thank you, Jonathan, for that presentation. Thank you. Like you said very well, for us to be a truly competitive market, we must be structured in such a way to attract the needed investment, be it FDI, be it equity, whatever it is, local finance. We must be structured in such a way for us to be able to attract that investment. But when you were making your presentation, I know when you said DISCO and public, I don't want to mention it again so that it will shake the table. I could feel the earthquake, So I know that is going to come up during our question and answer time. And I would invite you not to go away at this time. This is not a very good time to leave. It is really a time for us to sit back and watch this final session and participate in it. The questions have been circulated, and I'm telling you that we're going to discuss all that. And this final discussion we're going to be having, Dr. Bolanle Adebola is the leading expert in the Nigerian insolvency law and is a lecturer at the University of Reading, far away in the UK. And she has attracted grants, which has enabled her to establish the council, the Arts and Humanities Research Council grant, which enabled her to establish the Commercial Law Research Network Nigeria. She's actively involved and engaged in capacity building and development of modern corporate rescue and insolvency practice in the emerging markets. And right now, she's going to be discussing with our Chief Anthony Idigbe, SAN, the senior partner in Punuka Attorneys and Solicitors, to actually apply this innovative insolvency proposal to our energy sector. And this is a section you shouldn't miss. And if you have not been listening very acutely, this is time for you to stop whatever is distracting you and listen to this final discussion. It's time for you to take your presentation. Dr. Adebola.
Well, thank you very much, Ebele. Am I unmuted? Yes. Okay. Thank you very much for inviting me. Thank you to your Punuka Chambers Punuka Solicitors for inviting me to this very interesting webinar. I've listened a lot and learned a lot from all that has been going on. And of course, I feel really privileged to be giving another presentation with Chief Idigbe, with whom I've had a bit of a tag team now on some insolvency presentation. And of course, we all know that Chief Idigbe is, the person to go to when you want to understand practice issues in relation to insolvency. Well, Chief and I are going to just share a dialogue about the insolvency system in Nigeria. And I was wondering, since Chief is the chief questioner here as well, if he would want to, start by posing questions.
Thank you, Bolanle. It's a great pleasure to take this session with you. I just wonder, from your experience in insolvency, what do you think is from an insolvency point of view, what do you think is the nature of the problem?
Okay, I would run quickly through my perception of what is going on here. So we actually, when I was approached to talk about, how we can resolve the issues through insolvency law, I had to take a step back and think, what are these issues that we are talking about here? And, and I said, it is necessary to separate out the issues because we have a multifaceted problem that is really entangled and complex. And it is important to separate out the issues that insolvency law can resolve and the issues that insolvency law cannot address. So we have two key issues here. One is a business model issue, the way that the sector is structured and the way that it's expected to operate. And that is what generates the income that it makes. It also generates some of the costs that it produces. And then we have the supply of finance through the system. Now, that is a financial issue. It's a question of the financial model, and that is an insolvency issue. So here we have both a business problem or business challenge, and we have an insolvency challenge. The business challenge is the way that the sector is structured, and the insolvency challenge is the way that the finance is structured. So there are things that insolvency law can address, and there are things that insolvency law cannot address, although they come up, although all these issues come up in the sphere of insolvency. So when we're looking at the business model challenge, there we're looking more at issues relating to economic distress, we call it in insolvency. When you have an economically distressed entity or a sector, you have a sector that cannot generate enough income to meet the expenses that it has, as well as that's to meet its operating costs, the need for future investment in infrastructural development, and perhaps the human capital development to run that sector. Now that is an economic distress. And any entity that fits in that zone is economically distressed. Ideally, in insolvency law, we would say that the best option there would be to liquidate that company quickly, because that company is holding up the redistribution of value and capital across the economy, and you just keep sinking capital into that sector of the economy. When you have companies, however, that can meet up their normal operating costs, but they have a financial structure that has a lot of fixed costs, that's a lot of debt in it. What you want to do, what happens when such companies cannot meet those fixed costs or those financial, the debt that it has, is to gather the creditors together so that they agree to reduce some of the debt burden that the company is carrying, and the company can then be allowed to proceed for the future. So what we have here is really both economic distress and financial distress. And we have a lot of zombie companies actually within the sector. These are companies that cannot generate enough income to address their operational needs. So the problem, as I said, is quite multifaceted, and that's how I will separate them out.
Okay, thank you so much, Bolanle. I just want to push a little bit further, and thank you for the clarity about the economic distress, which the reform agenda was supposed to address anyway, because part of the job of the BPE, the Bureau of Privatization, is to look at every sector. If there is economic distress, they will reform it, and they've done it successfully, whether it's pension, whether it's communications, telephone, power sector. So they led the whole process of economic reform in Nigeria by basically tearing down the entire system and building a new system. But now they did the same thing for power sector, but we are in a position where it's now stranded, as I said, stranded policy. We will come back to that issue as to what the solutions are. And I think Jonathan has mentioned some reform agenda that could affect the economic distress or address it, and I'd mentioned some as well. But let us focus on the insolvency part. Can you tell us our current insolvency framework, is it suitable to address the financial distress part of the problem you mentioned?
Yes, thank you very much, sir. It's interesting that whenever there's a challenge, it seems as if we are overwhelmed, and that we suddenly run to the fact that our system is not working and our laws are not up to date, and there's no way that we can resolve the issues we have given the state of the law that we have. But I beg to differ, and I say very much that I do not agree with that. Now, the present problem that Nigeria is facing, say with power sector, challenges the insolvency regulatory system. Now, this goes beyond the law. This includes the judges. This includes the practitioners. This includes the regulators, the CACs of this world. It compels everyone to come together to the table to have a conversation in order to instrumentalize the system that we have in place to be able to resolve the problem that we have. And Nigeria is not unique in this experience. If you looked at the World Bank, doing business, and looked at the insolvency part of it, one of the things you would see would be the informal workout. Now, that informal workout system was actually based on a 1970s challenge that the UK had, and the response that the UK regulatory system gave to the challenge that they had when they had problems of liquidity with their banks. There had been lots of syndicated loans, and big corporations were doing badly, and it became necessary to restructure those loans. And so they came up with what was known as the London approach, which has now become the basis on which out-of-court workouts are structured now, with a regulator in charge. At the time, it was the central bank, the Bank of England, as you call it, or the central bank equivalent in England, where it was the governor of the central bank that had a sort of informal oversight of the deal making in that system. Again, in 2008 in England as well, you can pick up the resurgence of schemes of arrangement. Now, we know schemes of arrangement very well. That's what we used to restructure our banking system in the 2004-2005 recapitalization and merger exercise. Now, prior to 2008, a lot had been said about schemes of arrangement in England, about throwing it out because it was cumbersome and long and not fit for purpose. But when they had a crisis, that was the global financial crisis that they had at the time, they realized that schemes of arrangement could be re-instrumentalized to resolve the problem that they had. Now, the difference between schemes of arrangement and informal workouts is that with informal workouts, you need consensus, unanimity, so 100%. One person cannot stand out. Now, when you find that you cannot have this 100% agreement, you need a system whereby a majority that the law permits is allowed to agree to a deal and compel the dissenting minority to accept that deal. So with schemes of arrangement, you have something like the 75% approval and majority in the number of creditors as being the way to go to. So if we then came back quickly to Nigeria, we actually have fundamental tools in place that can be refashioned and reworked in order to achieve the goal that we want to achieve. And yes, there is the Incoming Karma Amendment Act. The Incoming Karma Amendment Act does not really fundamentally change the instruments that we have. It improves some of them, but it does not change the fundamental shaping of the insolvency system that we have. So there's nothing stopping us right now from addressing the challenges that we have with the instruments that we have.
Thank you very much. Well, let us let me talk a little bit about the system that we have and see what we can do with it. Let's take, for instance, our scheme of arrangement. Let's take, for instance, our receivership procedure, etc. We could, in Nigeria, use some of these schemes, and we've done a couple of papers on how the system can be improved and be used for business rescue, because until perhaps this new law comes into force, there's no clear provision under Nigerian law that enables you to go for business rescue. And I'm talking in terms of the tension which we have in Nigeria between the directors wanting to maintain control of the company and the creditors wanting to take over the control of the company. And you have this tension that is always there. And there's no provision that brings them together where the directors can maintain control if they can get a certain majority, as you have said, of the creditors to agree with them with a plan, and then they go to court, and based on that they get a moratorium preventing the others who want to hold out from taking over the company. And this then brings discipline to the system, and it deals with the issue of liquidity, because for those who agree, they may have to make some concessions on the financial issues, which may now create liquidity that we are looking for. And then there's the issue that system could force them to have better corporate governance, because part of the plan could include that they get a chief restructuring officer, or they get some change in management, whilst the board remains in control. So, in many countries, there's a tension between whether the insolvency framework is creditor friendly or whether it's debtor friendly, in the sense that it allows debtors to remain in possession whilst they go through the insolvency. One interesting thing that we saw from the pool, the first pool that we had today, was that only 1% said that the liquidity problem could be solved by Embed exercising its security rights. That revealed to me that a lot of the participants don't understand the role of Embed being a main creditor, holding those guarantees based on the vesting contracts that they have, or the whatever security they have from the discos, for instance, or whoever they have to support. And why is it that Embed is not playing that role as a creditor to force the insolvency system to work, and basically is putting it to a neck as the regulator to try to take a regulatory action as a way to control or get the discos to be disciplined? Now, there's a tension there. What's your view? Should it be Embed playing the role of a creditor to use the insolvency system to try and achieve liquidity and governance change? Or should it be the regulator who is not a creditor and who can only act under his own law and not under the provisions of CAMA, which Embed can act, that would drive the process? What's your view?
Well, thank you for giving me a very complex question to answer there. But it's really interesting in the sense that, you know, in Nigeria, we have a very funny structure. And that's why I talked about the regulatory system, not simply the law. Because if we looked at the law, then we could say that we are quite constricted. But if we looked at the regulatory system as a whole, including the guardians of the system, you know, your judges, your practitioners, the people who control, your regulators who control things, then it's a very, very interesting system that we have in place. So on the surface of things, and, you know, if we go back to CAMA, the history of CAMA and the, you know, introduction of CAMA into Nigeria, one of the things you read in the history of CAMA is that they kept a system that structurally resembles the English system, but conceptually had a few changes. And the reason for that is still the problem or the challenge that we have today. The Nigerian system behaves in this way. On the face of it, we are like the English insolvency system, very creditor driven. In the way that things actually work in practice, we're like the US system, very entrepreneurial or very protective of our entrepreneurs. And you often get to court and you would find judges saying, do you want to kill him? It's only money, just let him go. Because we want to protect the man and we want to protect his business and his entrepreneurial activity. And in the US, it is said that if you have not failed before, you have not started business. So we have that tension in the Nigerian insolvency system. And the question is, how do we resolve that tension? And that's where the guardians come into play. So we have people like you, practitioners, and then we have the judges as well. And it's important then that those that are approaching the system, you know, bear this in mind, and those that are guarding the gates of the system also understand the goals that we are trying to achieve. And again, that's why I would think that a dialogue on the the political structure of our insolvency system, you know, is necessary so that we structure things to reflect the practices that we want. But to then answer your question very quickly, well, I think that given that we want a market-driven system or a system that can be consistently applied, you would want something that fits within the corporate law framework that we have in place, such that it should actually be Embed that is taking decisions. But the political fallout of Embed pulling its guarantees is that your banking sector can collapse. And that's why I think that there has been a very, very careful, you know, pass the parcel type of approach that is being taken. So I will then throw a question to Chief, actually, that if you know, how, if we were supposed to place this arrangement, say you talked about the moratorium, if we were supposed to place an arrangement, a schemes of arrangement within a framework, then it would be best to place within perhaps liquidation as opposed to receivership, because liquidation gives the liquidator certain powers against the governance structure of the company, particularly the directors of the company. And as the Ibadan Disco case showed, you can't just simply say NEC should take over a company because the law has certain provisions in place. What has been your understanding of the application of Section 506 that empowers liquidators to go at the directors of the company where governance proves to be a challenge?
Thank you so much. Well, looking at Section 506, first of all, it has a problem in the sense that it's only applicable at winding up. So the company will be dead already. And given what you have said, that the framework is that most of the time, they don't want the company to be dead. The directors don't want the company to die. The entire infrastructure and the cost system does not want the company to die. On the surface, it looks like it's creditor-driven, but underneath, it is debtor-friendly. And therefore, they don't want the company to die. So you never really get to Section 506. But in one particular case, I was able to get to Section 506. I wound up the company, And then I applied for the director to be made personally liable because there was no guarantee for the debts of the company, that he had mismanaged the company. And he has sworn to an affidavit that he did not keep proper books of account. And it's one of the provisions of the law that if you did not keep proper books of account, there is a presumption that you had fraudulently run the company and therefore liable personally under Section 506. And then I went to court several times. The judge kept adjourning it. And then on one particular occasion, when he saw I was serious about moving my application to now make this man personally liable for the debts of the company under Section 506, he said to me, "Chief Idigbe, you are very wicked." And I was like, "My Lord, what did you say?" He said, "You are very wicked. You mean you want to make this man personally liable after he has lost his company and etc." I said, "Well, but this is what the provision of the law says. And, you know, he's liable. This is rule of law." Anyway, the summary is I did not succeed. What would have been your experience in the UK in such a similar circumstance?
Well, in the UK, and as you would see in the incoming Kama Amendment Bill, you would go, perhaps if we placed the arrangement within a framework called of administration, that permits you to carry on running the business while an insolvency practitioner takes over control of the business and puts together the deal that will be put before the creditors of the company. Of course, to go into the heart of administration now is to start a webinar all over again. It has its limitations and its challenges. But the important thing about administration is that it permits you to carry on running the business, keep the directors in place, grant them a few rights, while you put a deal before the creditors of the company and get them to decide. It also permits you, if necessary, to sort of get rid of the smaller creditors if that becomes a problem. Now, in terms of directors and governance challenges that may arise, administration permits you to bring a charge of wrongful trading against the directors of the company that you feel that have contributed to collecting credit from the company at a time when they knew that the company would be unable to repay. Of course, that provision comes with certain protections, again, for the directors, such that even in the UK, there is a challenge, you know, for practitioners who want to enforce wrongful trading provisions against directors of the company. Nonetheless, that is, and that's where I see the judges, you know, stepping in again to protect the directors that you would have in Nigeria. But at least, again, those tools are always available. It depends on how you choose to instrumentalize them.
Thank you very much. Well, just to add to what you have said, and again, because of this very recent Ibadan Disco case, it's so important that we discuss it, because this was a case where NEC, acting based on a regulation that it made, removed the board of directors. And then the court held that it had no power to do that because under the substantive law, there was no power to intervene in that manner. And so that raises an issue what exactly is the power of NEC in terms of ensuring that there is proper governance, and what was the reason for the intervention? Was it a governance issue or was it a financial distress issue? If it was a financial distress issue, shouldn't it be the creditor that should intervene? And who is the creditor? Still taking us back to that issue. And if it was a governance issue, in what other way could they have intervened? So there's a clear blurring or difficulty there. But what I will always say with the jurisprudence for any sector is that it should be pursued to the highest level. So because the policy court in Nigeria is actually the Supreme Court. At the lower level, they are very technical. They just look at technical issues. But as the case goes up to the Supreme Court, the policy issues begin to come out in the case. So my urging is that all parties should pursue the matter right up to the policy court so we can have some proper guidance about the extent or the power of a regulator to intervene on governance issues, and the extent of their power to intervene in financial distress issues, and then the government as the major creditor in the sector to begin to explore other avenues outside the regulator, including some of these issues that you have mentioned. And it has worked in other sectors. Let me give you an example. Etisalat. The Etisalat collapse was managed completely in line with the London approach, as you mentioned. Now, Etisalat resulted in a bank challenge. Just like what will happen if there's an enforcement of security in the power sector. So it was the banks who would have suffered if Etisalat collapsed. So the banks took over the company, converted their loans into equity with the support of CBN on the side of the bank and the support of NCC on the side of the people trying to make sure that the 40-something million subscribers don't lose services. So they work together using the London approach to now set up a new management for the company, prepare it, and then sold it to the public. There were a few litigations here and there, but it was a successful transaction. You can see that sort of structure, informal workout structure, can still work for us in the power sector. But the question is who should drive it. In the Etisalat case, it was driven by the creditors, the banks, with their regulator supporting them. And I think that in the power sector, we should mimic it, and then you should have the creditor who will be the one to lead the process with the regulator supporting the process. I don't know what your views are about that.
Well, with an eye on the clock, I will say quickly that I agree with you. Just my last word on the Bado Disco case. Well, the options for the regulator at the time would have been to go through the company law to ask, for perhaps a liquidator to be appointed under maybe just an equitable principle rule or any other of the rules that were in place. But they didn't have a right to change the board unless they had equity, and they had. It is if you convert your debt to equity that you can then, have a power to take certain actions within a solvent company. They didn't have that, and that's the crucial challenge that they had. And that tells us something that, for one, I was proud of the court for saying, uphold the principles of the law, and you can't just, because you're a regulator, be above the rule of law. Now, as to the question of the way to approach things, I strongly believe that MBET is the one that should take the course of action here, because it wields the greatest power, and it has also the right of forbearance, the right to waive defaults, the right to withhold action while getting certain things in place. So if the government wants to act, I think MBET is the one to take the first steps, and with NEC beside MBET and perhaps the central bank. I would say very quickly about new money going forward. They're going to need new money going forward, and I'm really concerned when I hear Mr. Mahmoud say we're going to bail out the whole sector and and perhaps maybe give new money for going forward. The challenge with that approach is that in another year, you're going to end up in exactly the same position, because you have a failed business model, essentially. So that more joined up thinking between NBET, NEC, and the key players within this industry is necessary. But definitely, there can be a rescue package agreed if we join up all the thinking.
Thank you. Just to end, Bolanle, the last question. So we've dealt so much with the issue of financial distress, but you said there's the issue of economic distress, which you termed business regulatory reform. So what are your last words on that aspect? I haven't listened to what I said, what Jonathan said. What are your thoughts around the other business regulatory reforms that could be done to then facilitate the sector to become viable, so that you don't have zombie companies and you don't have repeat collapse?
well, as an insolvency person, I would say, well, you do whatever is necessary. Now, the model that you take will depend on the goal that you want to achieve. I suppose that I am sympathetic towards the position that is taken by Jonathan, in the sense that you want government to help out the system and to ensure that it contributes something to the sector, but to have an interesting kind of a modified maybe competition system, which they have, so that it's not entirely out of the hands of government. But then in Nigeria, we always have to understand the Nigerian factor. Every time we have the government in place, we always believe that, government is going to come in to bail out. So I understand your position to say, let government just sit as just to regulate the system and not get financially involved in whatever is going on. Given the negative implications of the word subsidy within our political system, I suppose a system that removes subsidy is absolutely necessary. But perhaps if you could arrive at a middle point between the two in a way that protects our economy, protects a fledgling sector that requires a lot of infrastructural development, something in the middle would be the best to help ensure that we can deliver a power sector that helps. And I was really, really surprised to hear that Nigeria should be supplying power to other countries in Africa. I'm going to have to call my parents again to ask them when last they had power as we know it. But hopefully we can all arrive at a conclusion that is satisfactory and beneficial.
Thank you very much. But before I hand over to Ebele to conclude, I just want to say that my statement is based on statistics, and it's just been confirmed that the installed capacity is very wide. And in that, apart from the actual production, there's a quantity that is stranded that they can produce in a minute, but there's nobody to buy it because of the liquidity problem. So we can supply West Africa their electricity, and we can even ramp up that capacity to about 40,000 very easily if we solve this liquidity problem. Ebele, over to you. Thank you very much.
Thank you. I know that our participants are not disappointed with this great conversation between two of you, because I can see the comments coming in. It was really very interesting. The mode of delivery, beautiful. Thank you, Dr. Adebola. Thank you, Chief Anthony Idigbe, for that very great conversation. And of course, he points us to there is hope in all this. At times, it may seem as if we're not moving, but we are moving. And I know we'll get there with this kind of conversation coming up. At least we have seen that there are ways we can go around it and still arrive at where we can. And it must be away from monopoly. Every form, we must make our market competitive. We must be able to deal with the business challenge and also the financial challenge. And do we have models in the system already to copy from? Of course, there are models all there for us to copy from. And I know that even our regulator that is here today has indeed gained, and as well as make us know exactly what they are doing already. I'm so sorry we will not be able to take any of the questions, but we took down all of the questions. We have collated all of them, and they are all going to be answered. We are going to forward it to all the panelists, and they are going to give their submission on all the questions. And this will be circulated to the email address you used in registering for this session. But before we go, we want you to just tell us take this final poll before we close down. The poll is just for us to get an information on what you think you gained from today. What do you think you gained from today, from participating in this webinar? Please, can we take the poll? What do you think you gained from participating in this webinar? This will enable our facilitators answer your question and take their final points. Please tell us, what do you think you gained from, what information did you gain from this webinar? That the government subsidizes the energy sector, understanding the liquidity challenge in the energy sector, role of government in addressing the liquidity issue, new proposal for restructuring the sector. Which one would you say you gained from participating in this webinar? It's always very important to assess and know that indeed your participation was not just a waste of time. We are at 38%. I will stop it at 50. I'm about stopping it. Just click on one of the answers. It's now 50%. So I'll end the poll now, and this would lead us to taking our final comments. I'm ending the poll. I'm launching the results. These are the poll. 9% finally understands that government subsidizes the energy sector. 54% understood the liquidity challenges in the energy sector. 6% understood the role of government policy in addressing the liquidity issues. And 31% got an idea of the new proposal for restructuring the sector. Thank you all very much, and I will stop sharing the poll result now. Thank you all so much for participating in that poll. But before we close finally, I believe the first question we had for this session was for Eric. Eric, please, I want you to take that question along with your last words. I want you to take that question along with your last word. The question was asking about the technological adoption of technology, digital technology, how it would impact on the changes that we want in the system. The adoption, please unmute yourself. Please unmute yourself.
All right, thank you, Ebele. From the discussion so far, we could see that technology plays a very significant role. I'll take this question from the angle of the metering of customers. We've seen that the liquidity issue is a challenge arising from the inability of the discos to meet their payment obligations, which in turn impact on other players in the sector. Now, technology plays a very significant role with regards to metering. And if that metering issue is addressed, I think the collection issues relating to the discos inability to get the full revenue stream from their own end will be solved. When you have technology adopted to deal with the metering issue, I think it will go a long way addressing the liquidity issues. Thank you.
Word, sorry. You have 1 minute.
I think it's been very enriching discussion. One of the takeout for me is understanding from the perspective of the government, that's from the paper delivered by Sharfuddeen, that the discos also have, notwithstanding the fact that they had the payment deficit from their own end, the way the system runs and works, and the fact that they cannot charge over and above the limit placed on the tariff, it shows that they also had their own challenge and difficulty. And it's something that the players in the sector should look into and see how it can be addressed. And also to customers, for all of us, customers, so that when the issues are being addressed and we are seeing increase in tariff and all that, we should know that it's part of the ways of addressing the liquidity challenge we are experiencing. Thank you.
Thank you so much, Eric. Eric, as I mentioned before, is the able head of our energy sector. He is directly involved in these cases involving the discos, and he handles them, he leads in them, and you can see that reflecting even in his last words. Thank you so much, Eric. It was very good having you participate in this session. Hello, Mr. Jonathan Cohen. Can we have your last word? You can unmute yourself. Thank you.
Well, thank you again for letting me participate. And I think it's clear to see that whilst there are some challenges for the sector from the presentations and the people involved in this call, I think the future looks very bright for the sector. And I'm happy to be involved and participate in future sessions like this.
Thank you so much, Jonathan. And I think coming from you, at least we take solace in that we're doing something right and there is a future in where we are going to. Thank you so much, Jonathan. Thank you. We appreciate you. Hello, Mr. Mahmoud. Hello, Mr. Mahmoud.
Thank you.
Yes. Yes, we can hear you, sir.
Okay. I think this is one of the best webinars I have ever been opportune to attend, and I believe it has been very educative to me in particular, and I believe we need to have more of it in the future. Thank you.
Thank you so much, Mr. Sharfuddeen Mahmoud, for those kind words. We appreciate you and we appreciate your partnering with PUNUCA in ensuring that we're able to deliver this world-class webinar. Thank you so much. And then we'll have no other person than Dr. Bolanle Adebola. Please, your last words. Thank you.
Well, thank you very much for having me. I've thoroughly enjoyed myself. I've learned a lot about the power sector. I think that the greatest takeaway I have from here is that Nigeria has enough to supply all of us in Nigeria, perhaps for interrupted power supply and to supply the rest of West Africa. So that, I think, motivates me really deeply to try to help to contribute to the resolution of liquidity issues and to perhaps help join up the conversation to deliver, the change that would be necessary to get us to that place, because it's important not only for everyday citizens in their daily living, but if we can get power in place, then manufacturing is going to pick up, and Nigeria is going to be a completely different place. Thank you.
Thank you so much, Dr. Adebola. Thank you so much. I enjoyed your conversation. I enjoyed the insights you brought, your knowledge of insolvency into the structure in our energy sector. Thank you for contributing your quota, because I look at it, all of us are involved in the nation building, and thank you so much for being a part of this. PUNUCA appreciates you. And now the last but not the least, in fact, I call him the greatest, we want to have the last words from my boss, Chief Idigbe. Thank you, sir. You can unmute yourself.
Thank you very much, Ebele. I think on behalf of the panelists, we have to thank you, Ebele, for moderating this session very well. There are also a lot of people behind the scene, technical people like Iheke, our head of insolvency, Okure Kalo, and partner in PUNUCA, who did marvelous work behind so many other people behind who made this possible. So for me, I'm just a masquerade. They put me on the stage and and tell me to dance, and I dance. But those who make it possible, there are so many of them. The excellent relationships that we have developed around the world, as you have seen with Dr. Adebola, with Jonathan, with Sharfuddeen. We are very appreciative of these relationships, and what I've also seen is a passion to want to serve and work for Nigeria. Nigeria has great potentials, particularly in power sector, and we just need to use our professional skills to assist the sector to release its potential. It will be bigger than the telecoms. Let me tell you why it will be bigger than the telecoms. In the telecoms, you use the phone and you switch it off. But in power, you put on one, your refrigerator, and it's on permanently. It doesn't go off. So I just want you to use that to know that if we get it right, and everything that has been said from collection is works, you know, and the power is actually there. So you will find that these companies will be bigger than the telecoms companies and will become the basis. Their liquidity will then become the basis for even more infrastructural development in other areas in terms of development of our bridges, our roads, our railway, etc. Because the liquidity from this sector will be financing the rest of the economy. So we haven't even started. It's a story of hope, and we just have to all be dedicated. Thank you very much, everybody. And of course, the participants, without you, will not have had a successful webinar. We appreciate all the comments. Unfortunately, we were not able to respond, but some of them we responded to. And to say that so there was one particular question about, you know, is there an advocacy group for policy? And I did mention that we are trying to set it up, an advocacy group for policy. And we need it in Nigeria. Unfortunately, we still have, somebody spoke about military mentality. We have that military mentality. We don't know that we are not in democracy. We've been in it for more than 20 years or so. And that is, you go to National Assembly and lobby, you go to the government departments and lobby for policy. So if you believe in competition, support those who believe in competition and support the policy, be involved with the advocacy, and make sure that if there's going to be a policy reverse, that you fight against it and drive your own policy agenda. So that we are trying to set it up. We hope that those who are interested will join. Thank you very much.
Thank you very much, Chief Anthony Idigbe, for that wonderful closing remark. Thank you, our wonderful participants, for being a part of this. Like we said, when we are coming up with this webinar, we wanted to make people understand the liquidity issues in the energy sector. And we're happy to say that at the end of it, from the poll, the last poll taken, 54% understood the liquidity issues in the energy sector. And of course, understanding it is a path that leads to a solution. Thank you so much for being a part of this. And like I said, Punuka, we have offices in Lagos, in Asaba and Abuja office. And before we go, I would want to thank the members of the energy team that put together this webinar we are looking at right now. I want to appreciate Onyeka, Ugo, Ben, Tochukwu, Tobenna, Peter, Omolade, Leroy, Isioma, Boma, Akin, and of course, our very amiable managing partner, Mrs. Idigbe, for helping us, for giving us all the support we need. And of course, our supervising partner, Chief Anthony Idigbe, for giving us all the support we need to ensure that we are able to deliver this world-class seminar to all of us. Thank you very much. For more information on Punuka attorneys and solicitors, you can contact us by sending an email to info@punuka.com, info@punuka.com. Or you can also visit our website, www.punuka.com, punuka.com, to send us an email. I'll send your question across and we're sure you will be sure. And of course, on the policy group that is being formed, that information, you can always get it from our website once it is set up and running, so that you can express your interest and be a part of what is going on. And most importantly, we want to thank the Almighty God for helping us for the success of this. Thank you so much, our wonderful participants, and we look forward to seeing you at our next event. Thank you, our panelists, who are all wonderful. Thank you so much. A round of applause to all of you. Thank you. Thank you.